Hello everyone, today is the 19th of May 2026 and in this new JustDario daily episodes, I have to bring you the latest updates on the worsening oil crisis that is unfolding in the real economy, and yet markets are, broadly speaking, still oblivious to it, even if the signs are starting to creeping through markets and are harder and harder to ignore. Today, we're going to talk about what's happening underneath the surface and what also I believe are going to be the developments into the following weeks when what's happening cannot be kept away from the public eye any longer. Before we begin, don't forget to like the video, subscribe to the channel, and turn on the notifications if you don't want to miss any of my future updates. So, today I want to begin sharing a video, a clip that has been broadcasted on CNBC. And Jeff Curry, one of the major experts on the field, actually lays out exactly what's happening out there, and especially how investors' expectations are dangerously misled by mainstream media.
Well, why is it that this weeks away from major crisis that you're talking about, why are people just so relaxed about it?
Because everyone that comes on here, besides the three people you listed, and there's a few others I'm not going to be, are very dismissive of this. So the expectations are that, hey, we're going to get through this. I like to point out that none of these people touch bushels, barrels, or metric tons of any commodity.
All right, so pretty self-explanatory. Basically, what's happening into the mainstream media is a great effort to hide exactly what's happening, despite the warnings that keep piling up. And I want to share with you some data. First of all, as you can see on your screen right now, we already had four SPR lease operation since the conflict in the Middle East started. And what's important here? What's important to notice, as highlighted, is that all these SPR operation were never fully allocated so far. And this is pretty interesting because if you expect that the situation is going to normalize very soon, then you have an incentive to buy the SPR and then dump this SPR in the market. And ultimately, when the price in the future is going to be much lower, you will be able to buy them back at a much cheaper price and then give it back to the US Department of Energy, including the interest rate that has been embedded into this lease operation. An interest rate that is actually very expensive, is up to 20% to be priced in barrel of oil. So why the various commodity traders out there didn't want to take this risk? Even if, as you can see here, so far the SPR releases have been pretty effective to cap the oil price to a manageable level for both markets and the real economy. The reason is that they know that prices are going to go much and much higher. By now, it's obvious to anyone that doesn't live under a stone that the conflict in the Middle East, especially the problems in reopening in the Strait of Hormuz, are not going to be solved anytime soon in the foreseeable future. And if you take a closer look at the SPR data, there is something that still didn't catch the attention of anyone so far. Before the war started, the US had roughly 450 million barrels of oil products into the SPR. And so far, roughly 133 million barrels have been leased for May, June, and July deliveries. And here there is an interesting thing. The SPR all-time low has been hit the last time in 2023 and was roughly 347 million barrels of oil. But if we apply a very simple math and we deduct 133 million barrels of oil from the 415 million barrels that were present in the SPR before the conflict started, we are sure there is going to be a new all-time low coming for the US SPR of 282 million barrels. And similar dynamics can be observed for strategic petroleum reserves held in other countries in the world. So here is the key. It is a fact that the significant draws into the SPR will continue for weeks. At the same time, where the supply deficit in the market persists and demand remains elevated. This is the problem right now. SPR cannot be refilled in the foreseeable future and potentially not even in the medium terms, because let's not forget, even if Strait of Hormuz is fully reopened right now, it's gonna take months for the whole supply oil system to normalize. And the market is completely ignoring so far any of this, perhaps because there have not been impacts into the daily lives. And here I want to remind everyone why the strategic petroleum reserves were set up in the first place. And here is a definition that you can find in the US Department of Energy website. The Strategic Petroleum Reserve, the world's largest supply of emergency crude oil, was established primarily to reduce the impact of disruptions in supplies of petroleum products and to carry out obligations of the United States under the International Energy Program. The federally owned oil stocks are stored in a huge underground salt caverns at 4 sites along the coastlines of the Gulf of America. The sheer size of the SPR, authorized storage capacity of 714 million barrels, make it a significant deterrent to oil import cutoff and a key tool in foreign policy. Great. I have nothing to say against this. But the problem here is that, as you can observe in this chart, the strategic petroleum reserves for the past years have been used as a tool to suppress oil prices. And that's not how they were intended to be used. And as you can see in front of you, you can observe the difference between what happened during the Biden administration when the Russian-Ukraine war started and it was happening right now. Let's not forget, at that time, there was no oil supply shock whatsoever. But the oil price spiked. And the administration effectively used the SPR as a day trading tool to force the oil price lower and lower. And why did they do that? They did that because the oil price is a key driver of the inflation in the economy. And even if the oil price was supposed to continue rising because of all the monetary printing that carried on relentlessly since COVID, they had to find a way to bring that down and portray successful taming of the inflation, while the opposite was effectively happening, because everyone that observes the market knows that the rate hike cycle of the Federal Reserve didn't even get close to restrict financial conditions whatsoever. And still, the oil price is one of the few commodity, maybe even the only commodity that never reached its all-time highs, that in this case have been recorded the last time in 2008, when, let's not forget, at that time there wasn't an oil supply shock either, but just an expectations that China would have continued growing incredibly and drain a lot of oil supply from the global market in order to support its growth. An expectation that completely fell apart when the great financial crisis hit. But fast forward to today, as you can observe in the most recent part of the chart, we are back at draining the SPR very fast. The first red arrow show how the market immediately discounted that in the prices. But this is the thing you don't want to see. Then the price bounced back up sharply, and even if so far they have been quite successful to hold the price around the $100 level, you can clearly see how the pressure upward is persisting. And the lower the SPR goes, the stronger the pressure to drive oil price higher would be. And despite all of this, the oil future prices manipulation continues. And we had another example on Monday when, as you can see in the chart, you can observe unusual spike in volumes that dumped the oil price as soon as it got above $105. And then 30 minutes after, once again, we get the very timely Truth Social post of President Donald Trump announcing that he would have posed a planned attack on Iran on the request of his allies, giving Iran 2 to 3 days more in order to go back to the negotiating table and agree to the terms that the United States will find acceptable. But we know already that this is not going to happen. They have been clear about that. And furthermore, now you can observe how across the globe, including in the mainstream media, there is a realization that cannot be kept away from the general public anymore, that effectively Iran came out as the winner of the first round of military confrontation. And the leak from the intelligence confirmed this, showing how the damages inflicted to the Iran military apparatus have been actually incredibly limited. While on the other side, as everyone knows, the damages that Iran inflicted in its asymmetrical counterattack to the other countries in the Middle East that supported the United States strikes on Iran have been of a much larger scale. And not only that, as it happened yesterday already with another wave of completely unexpected drone attack, and as it happened several times during the what we still pretend to be a ceasefire, their capability to penetrate the air defenses of the Middle Eastern countries, the UAE, Saudi Arabia, Kuwait, and Qatar, is still incredibly efficient. I mean, yesterday they hit the one of the energy distribution stations nearby a nuclear power plant in the UAE. Think about that. And quite hilarious, the market didn't react whatsoever. They still pretend like everything is onky dory. With an exception, though, in the government bond market. And here there is a very interesting discovery that I made, and I want to propose here today again, even if I posted already on X. And here you can observe the interest rate of 30-year US Treasury yields and the 30-year Japanese government bond yields. And as I highlighted in the chart, every single time this spread started to shrink significantly, at that point in time, we experienced significant financial stress in markets. 2008 during the great financial crisis, in 2012 during the European government bond crisis, in 2020 during the COVID crisis. And now we are observing the very same happening today with one difference. This time yields are going on the way up. And this might be even more dangerous because it might be a signal that central banks around the world might have lost a good chunk of control on the interest rate curve, especially on the long duration part of it. Furthermore, rising interest rate, as we've been observed, signal that not only the market is concerned by expanding debt across major governments, but is also concerned by the fact that these governments will not be able to control inflation. And as such, because they cannot control inflation and they cannot control their deficit, now investors are demanding higher and higher yields as a compensation for holding that government debt. And this is very bad news because if inflation expectations start to rise sharply, similar to what happened in the 70s, we're experiencing a similar pattern, then is when real troubles begin for markets. And here I want to conclude today. For the first time, I put my contact on screen. Happy to be supportive. Feel free to reach out. Be careful out there. Stay safe. Remains always grounded and objective in the valuation of your financial decision, especially when things are really on the edge of becoming extremely volatile. Thanks a lot for watching my video today, for supporting me on X, on Instagram, and for reading my research on JustDario.com. I wish everyone a nice day.